So as of today, this is probably the best category to invest into in fixed income. If you see deposit curve, which is kind of preferred investment option for investors, it's kind of inverted. What you get in 1 year, you don't get for 3 years and 5 years. In the government securities, the yield curve is still positively sloping. You get more for 30 years and 10 years than 1 year. We expect interest rates to come down. So anyone investing for the longest possible duration should do well. And Gilt Fund provides that opportunity. I think people are not comfortable with mark-to-market. In bank fixed deposits, they know this is where I have come in, this is where I will exit, and everyday prices are going up. Or there is a linear curve. In government securities fund, there is mark-to-market volatility. But as I jokingly tell people, ECG better should be moving up and down rather than a straight line. Same thing is true in investment. You better invest in something which is going up and down rather than a straight line.
It's only the volatility risk you should be aware that there is a possibility in the short period of time you may see some amount of negative returns. Other than that, there's hardly any risk in this fund. And as I said, asset allocation is very important. For your long-term asset allocations, to balance your equity and high-risky portfolio, Gilt Fund is one of the best bets, because when everything goes wrong, this is the portfolio which shines in most of the times and balances your portfolio in true fashion, and it has liquidity as well. Because when liquidity is not when you have it, it's when you need it. So at that point in time, you will get that liquidity, which is most important.
So unlike in equity market, fixed income markets in India are not that liquid. There are few securities which are called on-the-run securities. They do very well. And then there are large off-the-run securities that don't do very well. Now, in order to beat an index, you should be able to replicate it. Unfortunately, in fixed income indices, it's not possible to replicate because of lack of depth and because of on-the-run securities coming in index at the closing price and off the run going out at closing price. But there's no depth in the market to replicate it. So if you look at it, yes, some funds will outperform index once in a while when interest rates are falling and their duration is higher. Some funds will underperform when interest rates are high and duration is low. Over a period of time, will we be able to tag along with the indices? Answer is quite likely. And which is where Gilt Fund provides a convenient option to investors. The challenge with investors is twofold. As per RBI's data of financial households financial flow, in last 3 years, they have put about 9 lakh crore in currency notes. Now, currency notes is like holding ice on a summer afternoon. It's going to melt away. Why not put the money in Gilt Fund? They are liquid, they are safe, they have volatility, but the credit quality is as good as the currency notes, and it gives some return. The second challenge with investors is that either they drive the car in fifth gear or in the reverse gear. So they'll go straight and jump into F&O trading, or they'll put money in savings account and current account and bank deposits. Now you know that you have to drive car in all gears, and you don't go from reverse gear to fifth gear at one go. You take steps. So from current account, savings account, bank deposits, move to Gilt Fund. From Gilt Fund, move to hybrid funds like balanced fund, and eventually move into equity fund, and finally go into sectoral funds and small and mid caps and so on and so forth. So the equity market has higher volatility and hence higher return potential. Gilt market has far lower volatility and hence will always have lower return than the equity market. But you try to create a balance between debt and equity, between risk and return. So today, in the near future, let's say 18 to 24 months, there will be very good chance for interest rates to go down as Fed will start cutting rates from mid-24. FPIs will start investing in Indian gilt because of inclusion in bond indices. The fiscal deficit is well under control, and in the vote on account at 5.1% was way below expectations. Put all these things together, we believe there is a big figure change possible in Indian interest rates. Government securities are starting with 7% handle, they'll become 6%. Some of the corporate bonds and PSU bonds are starting at 8%, they'll become 7%. And hence the longest duration, longest maturity will not only get coupon income but also capital appreciation. Could we be looking at a double-digit kind of return over next 12 to 18 months in long duration government securities? Answer is yes. I am always going to say a fixed income gilt fund or a corporate bond fund will always outperform equivalent fixed deposit. And that's mainly because in fixed deposit, banks have a high overhead. And hence, if they are earning X minus overhead, which is 3.5%, they'll pass it on to consumers. In our case, our overheads are 30, 40, 50 basis point. So whatever I earn minus that spread, I will pass it on to the consumer. On a risk-adjusted basis, mutual funds should outperform bank fixed deposit in most circumstances.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.